Hello good people, you're most welcome to this Promise Show, and today I want to speak to you like a businessman. You know very well that Uganda, we are an import economy. We import a lot. We export very little. So our balance of trade is unbalanced. But even when we import a lot, we have been supporting the foreign insurers, the foreign companies. Whenever we import, maybe our traders are not sensitized enough to know that we have local insurance companies that can provide this service at even a cheaper cost and even with a wider coverage. And today I want to talk about that because there's a policy in the offing in the parliament that wants that we utilize the local insurances. There will be an insurance portal that will be talking about all these things and fast tracking those insurance policies, certificates, all the way from the port of origin, beyond the port of destination, which is most times Mombasa or Dar-es-salaam, then even up to your port or your warehouse. So whether in Kampala, whether in Malaba, whether in a trading city, whether in Gulu, we can extend cover up to that point in time. All right, so let's go for a short break and then come back with details of how we can go about this package. Thank you. All right, welcome back from that short break. Emmanuel here, still taking you through what marine insurance and goods in transit are all about. So the difference very quickly is marine insurance is from overseas. You're covering your items, your stock in trade that you have bought from wherever to come and trade within Uganda, and you have you have a bill of landing, you have a pro forma invoice, and that is the cost and freight. You have all that whole invoice. If you also put CIF, that is if you're getting insurance from outside. But remember that insurance outside is just covering up to the port of destination, which most times is Mombasa or Dar-es-salaam. So it's better you take out a marine insurance cover with the local insurers where they're going to cover you even up to Uganda, wherever you are. So this is an illustration. But before I delve into the figures, I also want to tell you that I know this family, this prominent businessman in the 90s who ventured into oil and gas, importing oil into the country. He had imported it from one of those countries. It was a consignment worth about $1 million US, and that was big money then. Even now, it's still big money. But imagine the ship capsized with his whole cargo at sea, actually in Somalia area. Possibly there were pirates or something like that. You can't tell. There are so many risks when you're transporting your goods. And just because of that unfortunate incident, the businessman became nothing. He lost all his property, his lands, his property, and he had to start from scratch. So we don't need to be victims of shock any longer as a businessman. You have to know that you can transfer this risk. Yeah, many times you are only forced to buy insurance because the bank has demanded for it. But the bank also wants to safeguard because they know there's an ocean of risks surrounding us. So very quickly, let's go into this example. Maybe what I will tell you, the disclaimer here is this is an example of items that are for trade. It could be supermarket items, general merchandise, but different items attract different rates. So whether you're in machinery, are you importing cotton, are you importing agricultural produce, name it. All those have different rates according to our regulator, the IRA rating. However, we have to, now there are some things we don't cover, things like gold, because those are very hard to really protect. There are some items that we shall exclude, but we may not delve into here. But nevertheless, as long as it's formal, it's going to attract, you have those pro forma invoices, you have your bill of landing, that is sufficient enough for us to cover from that point of origin up to wherever you want to take your items. So this is an example. So marine insurance is for overseas, then like outside of the country. Then goods in transit is something by the road or by ship, but within borders or on land. Remember, there's also air freight, that is also marine, but if you're going to purchase items and they come by air, that can also be covered under marine, but mostly marine talks about the shipping and the freight element. So this is the description that I wanted us to start with. So let's delve very quickly. What is marine insurance or goods in transit covering? It's covering any loss or damage, destruction to property for which the insured is responsible by the insured perils like fire, accident, and theft, which have been carried on by any conveyances specified in the schedule, including a loaded or unloaded from any such conveyances. So whether they are offloading, whether they are unloading this property to your warehouse or from the ship to wherever, and there are damages, you can claim for such a cover. Policy extensions, yes, we talked about loading and unloading. We talked about road and rail. All those are covered should anything happen to that conveyor vehicle, whether it's a train or it's a truck that loses control or loses and just has an accident, capsizes, we have to compensate. Then transit, temporary storage, all those are covered. Then there are those riots and strikes. We are traveling within a place like Kenya where there are post-election violence and your truck happens to be a victim, you can claim for this. So this is an example of something coming from Mombasa to Kampala warehouse. Then conveyance, this is by trucks, road to ship. And then the interest here is an example of a 40-foot container of trading merchandise worth 100,000 US dollars. If you convert that into Uganda shillings, that will be roughly about 350 million. So if we consider that freight, and very quickly, yes, as you have seen there, there is annual transit. Of course, if you're doing annual transit, the rate becomes lower. If you have just transit per, limited transits, the rate may be slightly higher, but we can negotiate as a partner. Then there is what we call minimum excess. This is very clear that should any incident happen to your merchandise while in transit, we're going to compensate up to 90%, and then you as a client contribute 10% of the insurance claim or 100 US dollars. I hope that is very clear. So if the ship capsizes and you lose your transit worth say 350 million, will make you contribute 35,000 US dollars, then for us to contribute the 90%. I hope that is very clear. That will be about $315, $315,000. So very quickly into the premium. This is an illustration. You see that premium is about 1.4 million, and then if you put the training levy 0.5%, comes to 7,000. You're looking at VAT 250,000. That's 18% of the other. So you're seeing the total premium of such a container worth 350 million, and we're charging you 1.6 million. So as a businessman, which one is better? For you to go blindly into trade, into purchasing these items? Yes, much as these people are trusted suppliers, but anything can happen within that period. They have left his warehouse up to your destination. Should you take that risk, or you can actually just transfer it to the insurance company? The other element we have seen are for people. There are some traders now who use this as an advantage to gain, to give something more to their client, for the client to come back again to them. They tell you that, you know what, for us, if you buy from us, and now this is under the goods in transit element, if you buy from us, we're going to supply to you wherever you are, whether in Fort Portal, whether in Gulu, whether in Kabale. And then they will put a catch phrase that, you know what, should anything happen to these items while on transit, we shall compensate you. And you wonder how they do that. And even when they do that, you wonder how they have done it. But because they had an insurance policy, of which we shall discuss next time, and business risk, there is a whole other package that we shall discuss next time. So for today, I want us to really support the local insurers. This is my last call of action. Let's support the local insurers and not go to the foreign insurers going forward, because this service is here and you're actually covering up to Uganda port, not just up to Malaba or Busia, not up to Mombasa or Dar-es-salaam coast. You can bring it beyond and you're covered, because there are even more risks from Mombasa up to Kampala, because there are so many thugs, there are so many people who waylay those trucks. So there's a lot of risk. But how do you cover all that? If you have an insurance policy like this, it will help you. And how do the insurance companies manage to pay so much when they have only received so little? Is because we have so many, we have a big base, solid base. And as again, we always bring these insurance companies to you to see how solid they are to take on your kind of merchandise. Whether it's oil and gas, however much it's complicated, whether it's agricultural machinery or produce, we can cover all that. Well, thank you so much for your time and attention. Remember to subscribe just below, and then I'll be waiting for your comments or your feedback on the comment section below. Till next time, I thank you. I mean Emmanuel Sani Safali.